thank you for joining us again for the top questions that my top lenders here in Colorado get asked. We are here with Mike Kenovan and Brett Baird, and the question we have for you two guys today is, what is the difference between a conventional and an FHA?
Oh, yeah.
You can start conventional?
Yeah. No, you start FHA.
Okay, I'll start FHA. So FHA mortgages are backed by the Federal Housing Administration. So it's essentially backed by the federal government. They require very little down payment, and they require mortgage insurance, which was recently changed from 1.35% down to 0.85%, so a net difference of 0.5% to the buyer monthly. I ran some calculations on it, and on a $200,000 purchase price, it's about $90 a month in savings for the life of the loan. Basically, what the FHA does and what mortgage insurance does on these loans is if the client were ever to lose the house, it essentially acts as gap coverage. Let's say the client owes $200, the bank sells it at $160, there's a $40,000 loss. Well, the mortgage insurance covers that loss so the borrower doesn't get sued from the bank.
Perfect. Can you just real quick give a definition of gap coverage for those of us who are not familiar with that term?
So gap coverage would be more a term that we would use for vehicles, for insurance for an automobile, but mortgage insurance works in very much the same light. So it basically covers the difference of what you owe and what the property is sold for in this case.
Awesome, thanks. What about conventional, Mike?
Conventional, you got two. You got Fannie and Freddie. They're both privately owned companies that pretty much handle all the conventional loans. So there's reasons to do conventional loans versus FHA. Conventional loans overall typically are a little less expensive. Do you agree with that?
Yeah, I think right now, depending on FICO score.
Right. So there's reasons to get into a conventional and an FHA. Conventional might not have mortgage insurance depending on your down payment, and then they won't have any upfront mortgage insurance.
Correct.
Interest rate on a conventional is a little bit higher than an FHA. What else you got?
Why is that?
Why is that, Brett?
Why is that? It's just FHA, because it's backed by the government, typically the rates are just really low, but you have to factor in the mortgage insurance,
Right.
which again, if you're at a 4% rate on an FHA, you're technically at a 4.85% rate with the new mortgage insurance. So I priced out recently a loan with someone with 5% down on a conventional loan, a 680 FICO score, and 3.5% down on an FHA, and the FHA comes out a little bit less. However, the big caveat there is going to be once you pay your principal balance down to 78% on the conventional loan, if you choose not to put down the full 20%, your mortgage insurance would be eliminated at that time. On the opposite end of the spectrum in FHA, it is perpetual. It's for the life of the loan. So long-term conventional, if you can afford it, if your credit's good enough or good enough to get it, I think it could end up being a cheaper loan over the life of the loan.
Anything else to add, Mike?
What he said, that's pretty good.
All right, guys, thanks so much for answering these questions, and I appreciate your time. We'll see you next time.
The market, we have things that are predictable and things that are not predictable. The 10-year yield moves every single day, fluctuates with the stock market. Basically, banks get paid first. So you make your first payment, and X is going towards interest payment to the bank, and a little bit is going to principal.